Hey, how's it going? It's Joe Malerba again from eXp Realty in Niantic, Connecticut. I'm your local investment expert. Today I wanted to talk to all you business owners out there. Number one thing that I see with so many business owners is that they just don't understand how affordable it can be to go buy your own building. So today I'm going to talk to you a little bit about how it could be more impactful for you and your business and your long-term wealth to buy instead of rent. As you well know, I'm a numbers expert. I spend as much time as I possibly can understanding the nuts and bolts of the deal. Did you know that as a business owner that you can go out and buy a building as long as you occupy 51% of that building? You can buy that building with as low as 10% down. So the SBA has a 504 loan. The 504 loan will work in conjunction with a local community bank, and this bank will allow you to buy your very own building with much less money out of pocket. And I've even seen many of the people that use it also use it for something called working capital. Now, working capital can be for a build out of a new building that you're building. I just had one of my very close friends and really great guy just buy a new building. The building that he did, he was able to use the SBA to not only purchase the building, but he was also able to use the SBA to pay for the renovation of the building to meet the specs that he was looking for. So he has an office that brand new day one is much better than what he was living in. Plus, the building will now also have apartments in it. These apartments will actually pay for the entire mortgage of his building. So it did take about a year from the time that he got the building, went under contract, and then from that point did the renovation and then moved in. That being said, now, roughly 14 months into his purchase, he will have rents coming in that will cover the cost of his building. Let me talk to you a little bit more about that. So, your average rate on your SBA loans right now now again, this is March 2026, so it's specific to today. They're hovering around 5.8%. You can get a 25-year fixed term loan and you own the building. Now, why does that mean a lot? And what does that mean to you as a business owner? So if you're paying rent somewhere that's say $4,500 a month, the average rent that's $4,500 a month within 10 years will be close to $5,700 a month, which is a 3% increase every single year. Which means that as long as you continue to be a renter, you're subject to the cost of inflation and appreciation in directly affecting how your business runs. Over that same 10-year period, you'll have no equity built. So every single month you're going to pay somebody else's mortgage, every single month you're going to pay somebody else's bills, and you're not going to build long-term wealth. Now, in my world, long-term wealth and appreciation is my religion. We believe very, very strongly that we would love to help you build financial freedom in yourself and in your future. And this is something that we're very good at, is helping business owners out there take more money and keep it for themselves. I'd like to dig a little deeper into these numbers for you. So, if you're able to get the SBA to only 10% down, the 504 is one of the gold standards of this. The 5.8% rate is significantly cheaper than most commercial mortgages out there right now. And you work with a local bank to fund the balance. SBA works in conjunction with local banks. This will make a meaningful impact over your life over the next 10 or 20 years. So, on a $500,000 property, if you're going to buy a property for $500,000, day one, the mortgage would be roughly $4,200 a month. Now, obviously, this is going to depend greatly on how much the taxes are, how much the insurance is, and how much the actual moving pieces of the building are. But if we're assuming a rent of $4,500 a month to buy a $500,000 building and to be actually spending $320 less per month, $4,000 a year, that's a massive difference. Now, what that doesn't take into consideration is the many tax implications that come along with this. So one, the mortgage rate will be locked for the 25 years. So that will allow you to have a locked-in payment with the exception of taxes and insurance going up over time. Two, you only have to occupy 51% of the building. So as long as you're occupying 51% of the building, you can rent out the other half of the building. Which means that now you can get somebody else to help pay your mortgage, and you might, like my friend, be profitable day one, or at least have somebody else cover most, if not all, of your mortgage. This is huge. The second thing is, if we were to assume a 3 to 4% appreciation per year on a building like this, that would mean that the building value would double in about 10 to 15 years. So every single year on that $500,000 building, you're going up $20,000, $30,000 in equity, because every year it gets to be a little bit more. That makes a meaningful difference on your bottom line as a business owner. Now you're no longer just paying the bills every month. You're building true wealth over a long period of time. Now, if you have a building and a business that you hope to sell someday, this can really make a meaningful impact on your long-term retirement ability. Because like my friend, if he decides to sell his building in 20 years when he's done, now he can rent the building back to the new owner of the business, and have a second source of income. So in fact, I have quite a few of my friends that have built these pretty spectacular businesses, and when it came time to sell the business that was generating quite a lot of income, they made part of the deal that the new person had to rent out their building for a certain amount of time, guaranteeing them a consistent form of income for decades into the future. So last but not least, I'd like to talk a little bit about the tax advantages. When you rent, you are able to write off the rent. When you buy, you are able to write off the mortgage. Many people would think that's a wash. I can write off my mortgage, I can write off my rent. It's the same thing. However, there are significantly more tools that you have in your quiver as an owner of the underlying real estate. Number one is depreciation. Most commercial buildings are written off over 40 years, 39 years, and that would mean, so I'd like to talk a little bit about the tax advantages. When you rent, you are able to write off the rent. When you buy, you are able to write off the mortgage. Many people would think that's a wash. I can write off my mortgage, I can write off my rent. It's the same thing. However, there are significantly more tools that you have in your quiver as an owner of the underlying real estate. Number one is depreciation. Most commercial buildings are written off over 40 years, 39 years, and that would mean, in addition to the building being able to be depreciated, you are also able to write off your operating expenses for the building. If you improve the building, there are certain improvements that can even be taken as 100% depreciation in the year. And again, you are buying a long-term appreciating asset that will continue to generate cash flow if you play the game properly, and can help set you up for retirement. If you're a business owner out there and you're still renting, give me a call today, 860-912-7315. I would love to help set up a way to help you buy a building instead of continuing to rent. Obviously, this is not tax advice. Please consult with an accountant before you take anything to effect. However, we have a great accounting team, and we'd love to help you with setting yourself up for long-term financial freedom. I'm Joe Malerba with 𝐓𝐫𝐿𝐴 out of Niantic, Connecticut, and I'd love to help you.